I think the interesting thing around the Fed, Joe, is the tapering. We're so worried about tapering. I think it's already been going on for 3 months. I think tapering's already happening. The annual growth in the M2 money supply has fallen from about 27% in February to 17% at the end of April. And it's probably even lower when the May numbers come out. Real money supply growth rate's fallen in half from about 26 to 13% over that same time period. And so we're well into tapering. You know, everyone focuses on QE, which the Fed controls. But I think the real tapering is money supply, which historically has been the best measure of real liquidity. And the private market plays a role in that. And they've been tapering since February. And you're kind of seeing the impact on the markets. I mean, growth stocks have been trending sideways since then, particularly tech stocks. Small cap stocks haven't gone anywhere. The S&P is up just a little over that period of time. I think tapering is already impacting us. And what's interesting about this is the money supply growth rate probably will be back to normal by the end of this year, back into the normal range, maybe 5 to 6%. And tapering might be over even before the Fed starts to taper quantitative
easing. Jim, it's like
easing.
Stealth tapering, because the Fed can do this without even letting us know. They can act like they're full bore. And you heard all those comments where at some point in the future, we're planning to have a discussion about having a plan at some point in the future. That's the discussions we hear. And you're saying it's been going on anyway.
Yeah, I think what's interesting to know, we give so much attention to the Federal Reserve because they hold press conferences and they have various members talking around the country, but the private sector plays as big or bigger role in this. I mean, you and me determine how the money supply grows as much as the Fed does, depending on our liquidity preferences. And what's interesting is private market monetary authorities, if you will, the invisible hand, has been tightening since February, which many economists would say is about appropriate, because that's about when vaccination started. That's about when the economy picked up dramatically. That's about when commodity prices started going up too fast. And suddenly the private officials decided to tighten and have continued to do so.
News. That's all good news, Jim, because you see that in the journal today, this economic rebound without historic parallel. That's how solid and strong and savings rates and consumers. This is going to be pretty rip-roaring. And the Fed probably doesn't need to be here. Now you got to talk to the fiscal authorities about what they're planning, don't you? Or who's going to rein that? Who's going to rein them in? But you love that. You're a Minnesota Humphrey guy.
We need a little spending. I'm hoping that winds down too, Joe. I really do, because I agree. I think we're going to have real GDP growth this year, 8% plus. Next year, maybe 4.5% overall. Those are, like you said, rip-roaring numbers by historic perspective. And we don't really need more liquidity right now, and I don't think we need more public spending for stimulus. We might need it for infrastructure. Because we got plenty of private spending going on. But the good news behind that is if inflation doesn't get out of control here, I think we're going to have maybe $220 share earnings on the S&P 500 by the end of this year. Current street estimates are maybe around 190. So there's a lot of room to have to force Wall Street's earnings estimates up higher as we move through the year. I kind of think the stock market has entered a trading range here through the end of this year. We might even have a correction, kind of a pause period, in part because there's tapering going on, in part because there's concerns about overheat and valuations. But if let's say we stay flat the rest of this year and earnings go to 220, we're going to enter next year with an undervalued stock market, at least back to 1990 on a trailing PE basis, with way below normal yields yet, even if they go up over 2% on the 10-year, and with the growth rate next year, maybe 4.5% in real GDP, which is above average growth. Below average values, below average yields, above average growth sets up a nice leg next year for another run in this bull market, I think. But the rest of this year could be difficult.
Shepard Smith here. Thanks for watching CNBC on YouTube.